Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning. Oh, well, you know what? Something's wrong. My camera's not working. I should have tested this stuff before I, started streaming. Hold on. If I just turn it off and back on, does that fix it? No. Why is it not? Hold on. Wrong one. There we go. How are we doing, everybody? Oh, and you know what else? We should have some music. Music would be nice. All right, guys. Well, yesterday, after the FOMC meeting, we started to get more regional banking fears with reports that, I'm sorry. I can't even remember. There's so many banks that have to remember and all this stuff. And it's just like, what the heck? It doesn't look good out there. Okay. Oh, you know what? Music is not coming out of the right spot for me. Okay. So anyways, clearly I'm not completely here yet, huh? I got 5 minutes. Got 5 minutes to pull it together, Seth. Okay, here we go. We got treasuries here. So yesterday, spiking up. I think some of that probably was, that they're expecting the Federal Reserve to go into a holding cycle. But then this spike up was the news about further banking crises. Here we have the S&P 500 just absolutely taking a puke. You can see that gap in the overnight session as that was happening. They've tried to kind of dig it back, but not been very successful. Oil going all the way back to 64. Report from the IMF suggesting that Saudi Arabia needs to keep oil at $84 a barrel in order to balance their budget. Yeah. That's a real mess. Oil really not looking very positive, and I think suggests some very negative things about the global economy later this year. Gold and silver spiking higher, man. Like gold in particular. Look at that. Woo, up to 2080. That's a move. Copper. Well, copper doesn't look quite as bad, but it's still kind of flat to down. Then we come over here. The Bitcoin still continues to just be all over the place. And the dollar. Not looking so hot yesterday. And not actually seeing much of a flight to safety bid either on the banking crisis stuff. So this presents an interesting situation where, you get the economy going poorly and you don't see flight to the dollar. That's kind of like the disaster scenario. Okay, so we've got initial jobless claims coming up here. Unit labor cost productivity preliminary coming out in about 2 minutes here. And we are seeing a little bit of selling in the treasuries off of the open here this morning. PacWest, by the way. PacWest is the name of the bank that's having troubles this morning. ECB rate hikes rates by 25 basis points, warns inflation continues to be too high for too long. Let's see here. Brannigan Barrett posting something here about the ECB. Really good. You know, they're much more aware of what's going on over in Europe. You read between the line that you take away from this is that inflation is a really big problem. However, the ongoing banking credit crunch poses a risk. So instead of tackling inflation head on and getting to a restrictive levels faster, we will prod our way towards restrictive levels and stay there as long as it takes to bring inflation back to 2%, which we forecast will happen in 2025. Okay, 10 seconds here for the news. Okay, initial jobless claims in line with expectations at 242 versus expected 240. So not too big of a difference.
Lower than the forecast of minus 63 spot.
Now for this swing trade, which is on there, you know, in case maybe we get more banking drama. I don't know if it makes sense to add on that. We did get touched on our average position though, so we could add there. Okay, so going back. The key takeaway here is that the EC is stipulating that the primary tool is interest rates. This suggests that an increase due balance sheet runoff will be slow and gradual. Finally, they keep rates at restrictive for as long as necessary matters because the front end thinks we get cuts possible December of 2023. This is a hawkish outcome as the ECB is committing to keeping hiking at upcoming meetings and pre-committing to keeping rates high until inflation comes back to target, which they expect only in 2025. Okay, so I think that this is an important thing. This is the same thing that the Federal Reserve is saying. The market expects that the Federal Reserve is going to start reducing interest rates. I know that we had an argument yesterday about when that happens, because I don't think it's June or July, but definitely by September, then the market, there's a significant portion of the market that starts to think that interest rates start coming back down. And neither the Federal Reserve or the ECB or any of the other central banks agree with the market on this. And so they seem to be suggesting that they're going to keep the interest rates where they are and just slow down the balance sheet runoff to deal with like the banking crisis stuff. And yet the 60 is selling. Yeah, well, we're getting some really heavy dollar. I would well, I'm not 100% sure what's going on here with everything. That move in the dollar started before all of this. No, I think you're on the right track, Live Action. It seems to me that the initial market reaction does not agree with Brannigan Barrett here. That the initial market reaction is that the ECB meeting was dovish, and hence we're seeing some flows into the dollar. Okay, well, I think we're in a very complicated situation. It's probably wise for me, since I don't have a live position on yet, to kind of sit on my hands a little bit and hopefully wait for something to happen. If I could see like a long come in. Good morning, Uzi. But we can pull up the KRE here. You can see the huge decline because of TAC West in the overnight session. Oh yeah, send me, yeah, just message it to me. I'll add it right now. Did it give you the, hey, you need to buy it now message? Because it's been 2 weeks. I need to get on that. I should be able to do some writing and recording this weekend, because I had all of that gravel. Yeah, well, you know how to get to it, right? You just go to help about, and it tells you in the about from the control center, and you can select and copy it there too. Okay, they've kind of bounced a little bit here. Oh, we are going to have an ECB press conference today, huh? Not my favorite thing. There you are. There you go. Should be good to go now. Really? I have another indicator I paid for a long time ago that wants $5 to transfer your machine? That is pretty lame. That is pretty lame. Yeah, you know, so NinjaTrader has like this licensing thing that's built into NinjaTrader that you can use. So when you use my indicator, it automatically sends, you know, information to NinjaTrader's server that you've used my indicator. And then I have a little screen that I can pull up that shows me all of the machines that have used it. I can just see the machine ID. I can't see anything that would be, you know, like, you know, problematic that somebody else be able to see. Just, I can just see the machine ID and like when you first installed it. And if you have a 2-week trial sort of set up like I do, then it tells you when that's going to expire. So I can go in and I can change that. I can like update it to a different machine. Like, it's all manual. And I wish that it was like an automated process. I wish that like as soon as you paid on eBay, that it would go and it would activate you in NinjaTrader and it do that all on its own. But I have to do it manually. So what that means is that if you have any problems with the indicators, you should just send me a message on Discord and I can take care of it. You're not the biggest fan of bothering me outside of streaming hours? You know what? I think that we need to get the stuff that goes on outside of streaming hours going better, though. Like, we have Discord. I haven't done a good job of promoting it. Like one of the things that I think is a weakness of our channel is that the Discord is really, really strong and the YouTube chat is really, really strong, but there's not a lot of crossover. The people that talk on YouTube chat don't talk on Discord and vice versa. Most of the people that come into Discord found it through Reddit because it's, you know, it's like the unofficial futures trading subreddit, right? Didn't start out as Speculator Seth's server, right? So I've been trying to think about like, okay, so what if I did something where I created a different channel where like maybe only I can start posts, but then everybody can respond to them or something like that. And I can regularly post stuff throughout the day. Usually off my terminal at noon. Yeah. It really is. I really think if you're gonna not even if you're going to trade for a living, but I mean just if you're getting serious into the trading, I think that you kind of have to limit the screen time. Like you really cannot just I see these guys that they will just binge on it, you know, like they'll start having some success and they start putting on big positions. And so they're sitting at their computer watching it all the time and they always burn out. They burn out and they'll get to a point where they start making poor decisions because of it. So yeah, that's why for me, it's turned into usually like if I can't get out of the position before the stream, I'm usually taking it off just afterwards. Which kind of sucks sometimes because like 2 days ago, I had a really good long and I wanted to keep it. And that would have ended up being like a $50, $80 winner or something like that. It was only at 25. Starts to mess with you with the posture. Well, something that I have been finding is that I really need to take a long walk. Like doing the trading and then programming all day and I'm sitting in the chair and then I'll go and I'll work out. And then after I work out, I'll sit in my chair. And you know, like I'll sit and watch TV or something like that. And that's no good. It doesn't work. It yeah, like there you need to get like a certain amount of like walking in there too. And I used to get that walking like at lunch because I would always walk to wherever I was going to go get lunch. But now that, you know, nobody works downtown and all that sort of stuff, want to get one of those under the desk treadmills. I don't know, but you know that there's this whole thing that like walking on a treadmill is different from like regular walking. That's why if you go to CrossFit gyms, they have these treadmills that are like self-propelled. But you go till noon, that's still like 3.5 hours. 2.5 mile walk, that's pretty decent. I tell you what, I remember when I was a missionary and there was this one area. It was actually like the nicest area. It was like Lenexa and Olathe Park in Kansas City. So like one of the richest counties in the United States because they have the lowest tax rate. Right? And there was one period where our bikes got stolen. Like it wasn't just that they got stolen, like they were locked up and everything, but they just got straight up stolen. And so we had to walk for like 2 weeks while we waited to get new bikes. And oh man, you know, I would think like, oh, it's just a mile away, like that's not that far. But like we would have walks that like would take us like, you know, 3 hours to get to and then 3 hours to walk back. And then that was our afternoon, which kind of sucked. gave us a lot of time to talk. That missionary, you know, if it was some of the other guys that I had been with, that would have been like a nightmare. But I enjoyed talking to this guy. We have sister missionaries who kept on crashing on their bikes, and so they had to walk too. Right? Then there was another period in the same place where it was just too icy to use the bikes, so we had to walk. But I was always just surprised that like how slow walking was. That like something that was just like a 5-minute drive before was hours and hours walking. Urban walking. Sometimes I wonder if I should get back into, well, not get back into, but when I was a kid, you know, doing scouts and stuff, they would have us hike a lot. And there's a couple of places that I've been that my wife has never been to, and I'd be interested in doing. And I've never done Angel's Landing, which like it seems like everybody here in Utah has done, and they say that it's like this crazy, amazing experience, and I've never done it. Now maybe that's something that I should do when the kids are a little bit older, but like I'm like, maybe I should be starting to condition myself to go and do that. It's getting around that time. I haven't seen anything yet. Actually, let's search for right now, because I like to go to the air show, and that's a bit of a, you know, you end up doing a lot of walking at that. But so far, there hasn't been any kind of like official stuff. Okay, it's going to be the end of June. It's Elder Holmes? I don't know who you're talking about. I want to do Angel's Landing. I've been in Utah. Oh, you're in Utah? Oh, no, you've been... I recognize that name. Or... You've been here a long time. In fact, are you the one that doesn't really trade too much, but you found us through the earthquake video and stops and visits every once in a while? Man, I need to blow my nose again. Well, I tell you what, Mr. M, I know every one of the million or so missionaries in the LDS church, and I've never heard of an Elder Holmes, so. Back below 06. So time to do a little bit of analysis here. I'm seeing that there was some selling off of that like initial news bounce, selling again in the 10-year, and I'm seeing it in the 30-year. The 5-year is still like net buying, so I'm continuing to see steepening on the yield curve, but not a lot of support in the order flow for if I wanted to go long the treasuries. And the regional banking sector ETF, you know, is still just kind of trugging along sideways. I mean, did he have a name tag that said Church of Jesus Christ of Latter-day Saints? It's not like that you can't, it's not like he can't counterfeit them, but I would think that it would be kind of hard. Okay, so it's time for Liqueur to start speaking. I'll switch over to that.
Too high and for too long. In light of the ongoing high inflation pressures, the Governing Council today decided to raise the 3 key ECB interest rates by 25 basis points. Overall, the incoming information broadly supports the assessment of the medium-term inflation outlook that we formed at our previous meeting. Headline inflation has declined over recent months, but
Orange
underlying
lady.
price pressures remain strong. At the same time, our past
Yeah, we talked about
increases
unfinished business sort of concept
euro area
before,
financing and monetary conditions,
and I am not.
and strength of
I don't really
businesses
subscribe
in
to the
real
theory.
economy remain uncertain.
There can certainly be some situations where we're moving down, and I can tell by the volume that they're going to just keep pushing because, like, that's way too much volume to be going there in order.
Achieve a timely return
Like what would you will often see happen is like large meta order comes in, meta order kind of backs off, retail and speculators keep trying to push it. And when they try and push it on their own, that's like hardly any volume that trades there.
the appropriate level and
No, and then
duration
it's
of
done.
restrictions. In particular,
And so you can get these situations where large meta order comes down, there's a lot of volume there, it backs off, and you have a pretty good
in light
bet
of
that
the incoming economic and financial
you're gonna get a second wave later.
dynamics of underlying
But this whole idea that like there are unfinished auctions that you can detect and that they're likely to come back is what's from my own research is
remain our primary
nonsense.
tool for setting the monetary policy stance. In parallel, we will keep reducing the Eurosystem's asset purchase program portfolio at a measured and predictable pace.
Why do you guys not like LaGuardia? I kind of like
The
her.
Council expects to discontinue the reinvestments under the APP as of July 2023.
She's trying her hardest.
The decisions taken today are set
Look,
out
the
in
central
separate
banks are doing the best they
available
can.
on our website. And I will now outline in more details how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. Looking at the economic activity, the euro area economy grew by 0.1% in the first quarter of 23, according to Eurostat preliminary flash estimate. Lower energy prices, the easing of supply bottlenecks, and fiscal policy support for firms and households have contributed to the resilience of the economy. At the same time, private domestic demand, especially consumption, is likely to have remained weak. Business and consumer confidence have recovered steadily in recent months, but remain weaker than before Russia's unjustified war against
Raspberry
Ukraine
Pis
and its people.
Sorry.
We see a divergence across
Managing all my
sectors of the
tabs
economy.
here.
The manufacturing sector is working through a backlog of orders, but its prospects are worsening. The services sector is growing more strongly, especially owing to the reopening of the economy. Household incomes are benefiting from the strength of the labour market, with the unemployment rate falling to a new historical low of 6.5% in March. Employment has continued to grow, and total hours worked exceed pre-pandemic levels. At the same time, the average number of hours worked remains somewhat below its pre-pandemic level, and its recovery has stalled since mid-2022. As the energy crisis fades, governments should roll back the related support measures promptly and in a concerted manner to avoid driving up medium-term inflationary pressures, which would call for a stronger monetary policy response. Fiscal policies should
Buffered
be
there a little bit, I
oriented
guess.
towards making our economy more productive and gradually bringing down high public debt. Policies to enhance the euro area's supply capacity, especially in the energy sector, can also help reduce price pressures in the medium term. In this regard, we welcome the publication of the European Commission's legislative proposals for the reform of the EU's economic governance framework, which should be concluded soon. According to Eurostat's flash estimate, inflation was at 7% in April, after having dropped from 8.5% in February down to 6.9% in March. While base effects led to some increase in energy price inflation from minus 0.9% in March to plus 2.5% in April, the rate stands far below those recorded after the start of Russia's war against Ukraine. Food price inflation remains elevated. However,
It continues to be sell here.
6% in April after 15.5% in March. Price pressures remain strong. Inflation, excluding energy and food, was 5.6% in April, having edged
I don't know.
down
I'm having a hard time
compared
sorting
to
out
March,
the macro
returned to
forces here
February
because
level.
it seems like what the ECB is saying here is hawkish,
Inflation
but
fell to
you're not
6.2%.
seeing the euro benefit as a
Energy,
result.
Industrial goods inflation fell to 6.2% in April,
I don't understand that.
from 6.6% in March, when it declined for the first time in several months. But services inflation increased to 5.2% in April, from 5.1% in March. Inflation is still being pushed up by the gradual pass-through of past energy cost increases and supply bottlenecks. In services especially, it is still being pushed higher also by pent-up demand from the reopening of the economy and by rising wages. The information available up to March suggests that indicators of underlying inflation remain high.
The way this is trading kind of makes it look like
Wage
that we'll
pressures
see 116
have
again.
strengthened further as employees, in the context of a robust labor market, recoup some of the purchasing power they have
So like
lost
this
as a result
this one at 02 half is like a good example of where it's
Moreover,
like,
in some sectors,
well, it's a decent amount of volume to have traded there
increase
for
their
it to
profit
just
margins on the back of
flip back
mismatches
around. Not that
between
it can't,
supply
but
and demand,
you know,
and
that
the
kind of suggests that there's a
uncertainty
large meta
of
order
high
selling and that will
volatile
continue.
inflation. Although most measures of longer-term inflation expectations currently stand at around 2%, some indicators have edged up and warrant continued monitoring. Let us now look at our risk assessment. Renewed financial market tensions, if persistent, would pose a downside risk to the outlook for growth, as they could tighten broader credit conditions more strongly than expected and dampen confidence. Russia's war against Ukraine also continues to be a significant downside risk to the economy. However, the recent reversal of past adverse supply shocks, if sustained, could spur confidence and support higher growth than currently expected. The continued resilience of the labor market, by bolstering household confidence and spending, could also lead
Part of me
to
wants to
higher
just
growth
put an order
than
at
anticipated.
116 even.
There are still significant upside
I
risks.
don't know.
to the
There's
inflation
a lot of liquidity on the bid for
These
some reason.
include
That's kind of
existing
weird.
pipeline pressures that could send retail prices higher than expected in the near term. Moreover, Russia's war against Ukraine could again push up the costs of energy and food. A lasting rise in inflation expectations above our target, or higher than anticipated increases in wages or profit margins, could also drive inflation higher, including over the medium term. Recent negotiated wage agreements have added to the upside risks to inflation, especially if profit margins remain high. The downside risks include renewed financial market tensions, which could bring inflation down faster than projected, weaker demand, due, for example, to a more marked slowing of bank lending, or a stronger transmission of monetary policy would also lead to lower price pressures than currently anticipated, especially over the medium term. So let's look at the financial and monetary conditions. The euro area banking sector has proved resilient in the face of the financial market tensions that arose ahead of our last meeting. Our policy rate increases are being transmitted strongly to risk-free interest rates and to the financing conditions for firms, households, and banks. For firms and households, loan growth has weakened owing to higher borrowing rates, tighter credit supply conditions, and lower demand. Our latest bank lending survey reported a tightening of overall credit standards, which was stronger than banks had expected in the previous round, and suggests that lending may weaken further. Weak lending has meant that money growth has also continued to decline. Summing up, the inflation outlook continues to be too high for too long. In light of the ongoing high inflation pressures, the Governing Council today decided to raise the 3 key ECB interest rates by 25 basis points. Overall, the incoming information broadly supports the assessment of the medium-term inflation outlook that we formed at our previous meeting. Headline inflation has declined over recent months, but underlying price pressures remain strong. At the same time, our past rate increases are being transmitted forcefully to euro area financing and monetary conditions, while the lag and strength of transmission to the real economy remain uncertain. Our future decisions will ensure that the policy rates will be brought to levels sufficiently restrictive to achieve a timely return of inflation to our 2% medium-term target, and will be kept at those levels for as long as necessary. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restriction. In particular, our policy rate decisions will continue to be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term target and to preserve the smooth functioning of monetary policy transmission. We are now ready to take your questions.
Thank you, President Lagarde. And the first question goes to Annette Weisbach from CNBC. Annette, please.
Thank you very much, President Lagarde. I have, of course, 2 questions. My first question would be on the rationale behind the reduced pace in the interest rate hike of 25 basis points. So why did you come up with that? And my second question goes to the U.S. regional lender banking crisis, which isn't over yet.
They give Odd the first question?
How concerned are you about potential spillover effects to the euro area? Thank you.
Well, thank you for your question. I will take the first, and maybe I will ask my colleague and friend, Vice President Luis de Guindos, to address the second one. So let me tell you a little bit about the mood in the room of the Governing Council. I would characterize the mood as determined. All governors are determined to fight inflation, tame inflation, and return it to 2% medium term. And we all concluded, as you have seen, that the inflation outlook is
Didn't quite get to 116 even.
For too long. I would say then that the mood was very focused, and yet it is an in-between projection Governing Council meeting. But we were extremely attentive to all data that was available to us. And obviously, one case in point is the bank lending survey that you all received or saw on Tuesday when it was published, and which contains a lot of intelligence and information about the intention and the comparison between the lending practices and standards with what was expected by the banks, and I'm happy to come back to that later. But it explains, obviously, the decision that we made we were method dependent in many ways, just as we are data dependent, because we have articulated the reaction function of our monetary policy decisions with the three key elements of the inflation outlook informed by the financial and economic data, the underlying inflation, and the strength of monetary policy transmission. So we checked all the data that we had against these three criteria. And as is always the case at the Governing Council meeting, there was a variety of views expressed. And I think that it's fair to say that everybody agreed that increasing rate was necessary, that second, we are not pausing, that's very clear. Third, we know that we have more ground to cover on the basis of the baseline that we had, which is still guiding us until we have our next projection exercise, and on the basis of the data that we have received in the course of the last few days and that we brought together during the meeting. So I think the ultimate balancing act, which received almost unanimous support, and that is reflected in the monetary policy statement in front of you, was really predicated on the methods, the data we received, the understanding that where we are is totally consistent with the baseline that we had for the outlook last time around. Remember, at the last March meeting, that's what I said. And second, that underlying inflation is still high. And third, informed by the bank lending survey and the data that we have concerning interest rates, which is a little bit outdated because it goes back to February, the transmission of our monetary policy is working, at least to the financing leg. And we're not yet certain about the next leg, which is transmission from banks to the real economy. So it's on the basis of all that that we made our decision. Now that we have, increased rates significantly and sometimes by very large increments, I hope assessing not assessing, but establishing absolute credibility on our determination. It was sensible in view of what I have told you to return to a more standard increment with the understanding that based on the information we have today, we have more ground to cover and we are not pausing. That's extremely clear.
Good afternoon. Turning to your second question, I think that we should start by a consideration. If you look at the characteristics of the US banks that are running into difficulties, I think that there are some common features. The first one is that they are medium-sized, regional. They share a very concrete and very idiosyncratic business model, and they are quite open to interest rate risks. They are vulnerable to an increase in yields. And I think that this model, this situation, is not extrapolatable to the European banking industry. Well, I will not repeat what we have said many times. European banks.
Do you think that this is going to be another one where they go like the full hour and after the equities open? Because that was really frustrating last time.
Remember that an increase in interest rates, in yields, is positive for the European banks because the increase in margins outweighs the potential losses that this increase in yields could cause in fixed income portfolios. But I think that it's quite clear that there is no space for complacency. One of the things that we have been all of us surprised is about how rapidly a bank run can take place and how rapidly a bank can be emptied. And I think that this is the combination of new factors. The first one is digital banking, and the second one is social networks. And the combination of both have given rise to a new situation. And I think that supervisors and regulators, we have to bear in mind that new framework, because we believe that this is going to be key in the near future.
Thank you, President, Vice President. The next question goes to Francesco Canepa of Reuters. Francesco, please.
Thank you, Francesco Canepa, Reuters. So my first question is about whether anyone at the meeting insisted on a larger rate hike or on a clearer commitment to more hikes. You just hinted at that by talking about ground to cover, but it wasn't quite as explicit as it was back in the winter when you were talking about steady pace and several rate hikes. Second question is about something you just said, which is, again, that you had more ground to cover. Would you say that we are still in the middle of the journey or towards the end?
Why is it that Europeans and even European journalists tend to
remind you of the Emerson quote.
how do I put this? They like dress more smart, like their look seems more smart.
Okay, and we are not pausing. And under present circumstances and based on what we have, which
like in the US, it's just like you just wear a suit.
More ground to cover. Okay, and there is a clear reference to that if you look carefully, and I know you have because you do that very well. But in the second paragraph of the monetary policy statement, we explicitly refer to that by saying that our future decisions will ensure that the policy rates will be brought to levels sufficiently restrictive to achieve a timely return of inflation to our 2% medium-term target and will be kept at those levels for as long as necessary. We have covered a lot of ground in the last 9 months, right? Moving from minus 50 basis points to plus 300 basis points. We are continuing this hiking process. As I said, this is a journey. We have not arrived yet. As to, the exact amount of, by how much do we increase rates? As I said in my introduction, in the response to the first questions, there was a variety of views. Some governors suggested that maybe 50 was appropriate.
Appropriate?
Also believed that 25 was appropriate. I didn't hear anybody suggest that 0 would be appropriate. So that confirms to you that this is a hiking journey that we are on, and it will continue to be so. But at the end of the deliberations, and having had a chance to confront our views and to answer the questions and to really sort of put everything in perspective, there was a general, very strong consensus behind the decision that you have in front of you.
Thank you, Madame Lagarde. And the next question is for Jana Randor of Bloomberg News.
Thank you.
Morning.
Good
afternoon.
Well, good afternoon. I would like to invite you to elaborate a little bit more on your definition of sufficiently restrictive. The IMF had a view the other day seeing...
Yes, but could you please elaborate on this term that is intentionally vague?
Do that as well. Would that be something, given the inflation outlook we have at the moment, that would be in the ballpark of sufficiently restrictive? The other question I have is that at the last meeting, you had a little bit of a debate about over-tightening and having to reverse course. And I'm wondering whether that discussion continued this time and whether you would actually be worried that such a scenario might be interpreted as a policy mistake. Thank you.
Well, thank you very much. I don't have a magic number of what constitutes, open quote, sufficiently.
I think part of the problem is that some people do have a specific number that they think is sufficiently restrictive, but we can't prove that that's actually
in the process
means anything. And so they've kind of been getting their way when we've been going that direction, but
to have restrictive, to be in restrictive territory.
You can't actually say that because
the rate decisions that we make, the rate increases that we decide, are actually having an impact on the economic actors. And when we look at the bank lending survey in particular, or when we look at the interest rates and the pace at which it has increased in the last few months, it is obviously the fact that interest rate decisions that we made and the interest rates level where we are having an effect. Is it a sufficient effect yet? We don't know, because
Are you gonna get that 116 yet?
we are not seeing the transmission at this point in time into this, what I call the second leg of the economy, which is the real activity, which then has an impact on prices and then reduces inflation. So full cycle we're not seeing yet. We're seeing inflation coming down, don't get me wrong, because headline is coming down as a result of energy prices having coming down significantly, as a result of the easing of bottlenecks. But we're not yet seeing the complete impact that we desire in order to arrive at the 2% medium term that constitutes our target. We are very attentive. We look at that. As you know, it's one of the three components that we look at, the inflation outlook. But it is restrictive, no question about it. Is it sufficiently restrictive? Not yet.
Thank you. Thank you, President Lagarde. And the next question goes to Martin Arnold of the Financial Times. Martin, please.
Thank you. Hello, President Lagarde. I have two questions for you. The first one is on the decision to accelerate the pace of shrinking the bond portfolio at the ECB. Does that mean...
Can I also say that the ECB has a much better audio setup than the Federal Reserve does?
Does that mean that you plan to reduce the APP to zero eventually? And the second question that I have is, was this decision part of a compromise deal to convince those arguing for a 50 basis point move to accept a 25 basis point move in return for accelerating the pace of shrinking your balance sheet? Thank you.
Well, thank you very much, Martin, for this sort of double question on the same issue of the APP. Well, I would say
step
number
away
one,
here for a second
made the
and
decision,
stretch.
but the decision specifically says we expect. So we expect to let the APP run off as time goes by. And in answer to your question about do we go to zero, if we do, then it's going to take the next 15 years. So I don't think I'll be around for that. I know I won't, and I'm not sure that you will be around. But the ultimate perspective is that one as we consider things today. We've decided to expect the effectiveness of that decision as of July, saving a little bit of optionalities just in case, simply because we have seen that the partial reinvestment that we decided back in, that has been effective since March, has actually run very smoothly and has been well absorbed by markets. So we don't see any point in not accelerating the move because there are valid reasons for that. Lower the amount of excess liquidity, complements our policy rate increases, reduce the side effect of a large balance sheet. All of that completely justifies the fact that the APP is let to run off gradually over the course of time, which will be an average 25 billion per month, not reinvested, roughly. But as I said, to run the whole APP program to zero, it will take 12 to 15 years, given the maturities of what we have. I would just reserve one thing, because we discussed it during the Governing Council, and it's not reflected in the monetary policy statement. As you know, we have adopted a tilting approach to our investment policy of the APP, and in particular for the corporate bonds, which are the prime targets of that tilting, in order to privilege those corporates that have a good environmental footprint, that have a transition plan, and that disclose all the appropriate information about their plans. Now, of course, if we go to full runoff, that tilting process is not going to be applicable, because there will be nothing to tilt it off. There will be no basis for that. So I think the jury is out as to how we can continue to deliver on our Paris Agreement compliant reinvestment program without the reinvestment phase. And how do we address that, which is something that we agreed we would take into account and consider to see how we respond to that. Was it a deal? No. No. I think there was a general view that was the right the right move, completely sensible, legitimate at this point in time, given the market absorption. I think some might have preferred to wait until the June meeting to announce it, given that it's effective as of the 1st of July. But, with the principle of predictability that we had agreed in the first place, we thought it was just better off to just announce it with reserving a little optionality on the side.
Thank you, President Lagarde. And the next question goes to Aude Kersulek of BFM TV, French television.
Good afternoon, Mrs. Lagarde. About the last banking survey,
I had them mixed up.
Is there a target for bank lending or limits in credit tightening? How do you monitor these indicators? And second question, you said recently in relation to bank failures on the Credit Suisse case that you really need to measure what comes out of this financial event. So what are the indicators that you're looking at? Would you say that there is a banking crisis? What's your view of what's happening?
I tell you what, this buddy of hers that's always sitting next to her.
Yeah,
he sure has a nice suit.
We know of.
I think he should fix his hair, but he sure has a nice suit.
Target 2%. That's what is riveting our attention.
Just cut it off, bro.
Survey
You'll love it.
We receive on a quarterly basis informs us about the tightening of credit to the economy, and it also informs us about what the banks assess will be or will not be the tightening. And it's quite a sophisticated survey. Which is really for information, intelligence, anticipation of the credit tightening now and the credit tightening going forward. It's also illustrative of the demand, and that's an interesting point, because in the BLS, the demand from corporates is really, really down. So that's learning that we take, which indicates that our interest rate policies is beginning to have an impact, because when asked, the corporates say, and we had a corporate survey that was conducted, they say it's the interest rates. It's not that we don't want to invest, but the interest rates are pretty high, and that leads me to the restrictive territory or not. Yes, we are in restrictive territory, because if that is the response of corporates, then it shows that it's work. On Credit Suisse, I think I'll say a few words, and then I'll ask my colleague, Mr. de Guindos, to also address that. But number one, it was addressed very swiftly. The Swiss authorities maybe did not have many choices, and it was very specific and probably a long-lasting issue that was lingering and had been lingering for a long time. So I certainly would not draw the conclusion that the merger between UBS and Credit Suisse to be decided is an indication that there is a financial crisis. Far from it. But we are learning. I think that we also learned the value of having rules, and the ability we had to come out very quickly on the pecking order of creditors actually mattered a lot. And I think that we can also take a bit of learning from that. When creditors, investors know exactly who is going to bear the brunt of outstanding liabilities and a situation of insolvency, it just helps. And we did that. I'm glad we did.
Well, just to add that on the question about the indicators that we consider, that we look at, well, we have a range of indicators. For instance, equity prices, bank bond spreads, the evolution of deposits. And we have not seen, the kind of situations that happened in other jurisdictions. So we had, let's say, a sort of, increase of tensions after, the events in the US with Silicon Valley and with Credit Suisse. And afterwards, the situation has been quite calm. So we are continuously looking at those indicators. But, clearly, now, the conclusion is that the European banking industry has been clearly outperforming the American one in terms of the tension, included in this kind of indicators and, the potential stress in financial markets.
Thank you, Vice President. And turning to our online participants now, I would like to give the floor to Francesco Nilfole of Milano Finanza. Francesco, please.
Thank you. Good afternoon. President Lagarde.
Oh, they still have lots of people doing this by Zoom?
How you reconcile your data dependency with the pledge?
What?
Pledge.
Excuse us. Can you repeat, because we missed a bit of your question?
Okay.
Can I explain what?
Can you explain how you reconcile your data dependency with the pledge of doing more in the future? It can be a little bit contradictory, like a forward guidance without a forward guidance. Maybe you explain.
I think everybody's learning a lot, though.
A little bit more.
I mean, the thing with finance is whatever is going on, people say that, you know, history rhymes, but I find in markets that it's always like something completely new. It's always like on the edge of our knowledge that the next crazy thing happens, you know?
A great emphasis on core inflation, also considering that core inflation has not been a good leading indicator.
They do things like moving averages on certain types of time series and stuff.
Thank you very much. Data dependency is not forward guidance.
At the same time, I don't think that how they decide their monetary policy is that complicated.
I'm not giving you the forward guidance that, come what may, or subject to...
Trading Floor Audio is tweeting about how Dick Winos answered 2 questions this time.
In the past, and it was very appropriate to have forward guidance as we were at the lower bound, and that was a tool that was very useful. What I'm telling you now is, given our baseline, the findings that we have, the data that we can analyze today, our judgment in the room is that we are not pausing. That applies to today. And based on what we see, we determine that we have more ground to cover. I'm not saying that in the abstract. I'm saying that with reference to the baseline of March, to what we are seeing in development. And I'm here saying we believe that we have more ground to cover. It is not state dependent. It is not time dependent. It is a judgment that we make today. So I hope I've been clear to try to explain to you how we can actually say that very firmly without giving forward guidance and being data dependent. Comes the June meeting, comes the July meeting, comes the September meeting, and so on and so forth, we will look at the data and we will use the 3 criteria.
Hey, Anastasia, how have you been?
Reaction function for monetary policy purposes.
Well, that must mean it's about time for the S&P 500 to open up, huh?
So, you've also asked me another question about core. We had long discussions about core, and we actually had many more discussions on underlying inflation, because core is interesting. Core is easy to communicate. You take headline, the whole basket of everything.
It's been, I mean, we got an ECB press conference going, so the treasury market has been moving.
But we want to go a little bit deeper into the index and the evolution that we see. And we have multiple measurements that you are familiar with. You know, the TRIM, the PCCI excluding energy, and so on and so forth. We look at all of those, and we try to understand from the evolution that we see, what is the likelihood of inflation evolution. So, I'm not maybe addressing you core versus headline, but simply I'm saying that headline is the objective that we have, it's the target that we have, that we've agreed in our strategy review. It happens to be what matters to people. People see all prices increasing, and we're working for the people of Europe, okay? Core, easy to communicate, but maybe not as informative as we want it to be, so that leads us to dissect in far more details inflation. Thank you.
Thank you, President Lagarde. And the next question goes to Christian Siedenbiedel of Frankfurter Allgemeine Zeitung. Christian, please.
Yes, thank you. Madame Lagarde, I'm sure many people will be interested to know whether the worst of inflation is over for food. Do you have that impression?
Thank you for that question, because it is food prices that is hurting most, particularly the most vulnerable people. And we know that because in the basket of consumption, the most vulnerable spend a lot more on food than those who are well off. So we pay special attention, of course, to food and the increase in prices. We have seen it go down, right? If you compare March and April numbers, so it is going down. But we have to be extremely attentive because there are multiple factors that apply to food prices, that apply to processed food prices. I think we have also flagged the fact that profit last year, in particular in 2022, have contributed to inflation. This year, 23, what we have seen of 23, we see more wage increases contributing to inflation. We would hope that through a good social contract, these drivers of inflation do not activate each other in what I have called in other places a tit for tat. You know, I want more wages, I'm not going to give up on profits, and you are then at risk of something that is much more difficult and would lead us to have to take more active measures in monetary policy. So I wish I could tell you, of course it will continue to go down, but I'm observing that it has gone down. There are other factors that will come into play. You know, clearly climate change is something that will have an impact, probably on a sectoral basis, probably in relation to certain food items. What happens in Ukraine is also going to bring another uncertainty in the background of cereal price in particular. But commodity prices have gone down. That is a fact. So hopefully it will channel to the ultimate consumer.
Thank you, Madame Lagarde. And the next question goes to Andres Stumpf of Expansion. Andres, please.
Good afternoon, Madame Lagarde.
Good afternoon.
Can the ECB continue hiking if the Fed stops? Is that a baseline scenario you are working on? And second question, do you have any estimates on how much tightening is the QT and the TLTRO maturity adding to the monetary policy stance? Can you perhaps phrase it in hiking or basis points of hikes? Thank you.
You know, I've heard the fiscal dependency, I've heard the finance dependency, I had not heard the Fed dependency. So the ECB is an independent central bank. You know, looks at what others do around the world, from New Zealand, which has been an interesting innovator in the field of monetary policy, all the way to the Fed and others. And it's obvious that the US economy, in whichever way it evolves, has spillover effects around the world, given its size, the depth of its financial markets. But, you know, we have a target, we have a journey. We know as of today that we have more ground to cover, and whatever the decision of the Fed is in the next few weeks, months, we are going to be riveted to our objective, and we'll of course take into account variables. You know, the currency, for instance, has an impact. Any spillovers will be taken into account, but we are not Fed dependent in that respect. As to the actual tightening impact that the APP runoff has, I don't want to commit a number, but it does not have a massive impact, suffice to say. But we can give you, separately the exact amount that has been calculated, but it's not material.
Thank you. And the next question goes to Anna Karismo of the Finnish television Yle.
Hello, and thank you for the opportunity, and nice to see you again. We met in Lapland. So, yeah, you have repeated that the journey continues and you are not pausing. There are many households in Finland, Lithuania, Spain that struggle with the much higher interest rates and have had to cut down on their spending.
That would be me if I was in a press conference like that.
When hiking the
All right, yeah, so.
And then a second one, what should they prepare themselves for? What can you say to them about the future? When can we see the policy rates going down and maybe affecting also the 12-month Euribor? Thank you.
Well, thank you so much, and it's nice to see you again in warmer circumstances. So, of course, we are aware of these households that have contracted loans with floating rates, variable rates, whatever you call it, and from Finland to Portugal, from some of the Baltic countries to Spain, it is the case that some families are hurting because the reimbursements that they have to honor have gone up as a result of the interest rate increases that we had to decide. This is unfortunately not something that we can, alleviate or attenuate, because our task is price stability. Our task is to reduce inflation. And the tools of choice that works in that respect is the interest rates. And we have to use that interest rates. Some countries are taking particular steps and measures, and some financial institutions are also looking at offering moratorium or delay. And I think that the best we can do is to really tame inflation in a timely manner, meaning as fast as we can, in order to then facilitate a return to different interest rates that would not be as high in the future. And I'm not here making any commitment to cut at any point in time. Thank you very much.
Thank you, President Lagarde. And the next question goes to Shogo Akagawa of Nikkei, Japanese newswire, here in the middle.
Thank you. You will travel next week to Japan for G7 meeting. What kind of topics do you want to bring at this upcoming meeting from European point of view? Thank you.
Thank you for giving us that angle from the East. I would hope that together with my European colleagues, we can learn from colleagues, particularly Japan, which has just now, which is moving into a new direction with a new governor. So anything that will be the Japanese monetary policy going forward, and any understanding that we have of their strategy review, which he has announced, will be of interest. And I would be very happy to share with him the learnings from our strategy review, which I had started when I took the job. I would also hope that we can explain to colleagues from Canada, Japan, and the United States that the Europeans together are going to continue to demonstrate resilience, capacity to operate together. And I would hope that in that respect, something that we say in the statement here will resonate, which is to agree on the fiscal governance in short order, so that in addition to having a monetary policy that is common to 20 countries, we also have a fiscal framework which gives governance to the 27 member states, and that fiscal policies that are determined by member states are also focused on value for money, for lack of a better word. In other words, putting in place the right reforms, focusing the spending where it is going to increase the competitiveness and the efficiency of the economy, which is something that is absolutely indispensable in order to have this social contract, which is often associated with Europe. Thank you.
Thank you, Madame Lagarde. And the next question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Good afternoon, and thank you for the opportunity. If I may go back to quantitative tightening, just to understand whether there is more ground to cover on QT, or whether with this end of reinvestments on APP, this is the end of QT. There could be more to be done with PEP, for example, starting on pandemic, or selling bonds to make it even quicker. So,
well, we're like 7 minutes into the equities trading session, and that KRE is already under pressure, and I can see a little bit of a bid coming into the treasuries.
If I may, is on TLTROs, because even if the European banking system is solid and resilient, and the banking crisis from the US could be over, we hope, still TLTROs are going to end in an odd moment. And are you concerned or are you confident the banks can give back 500 billion in June and get away with it?
477.
407 about, yeah. Thank you.
Thank you very much. On QT, let me be very clear. QT is the decision that we expect to implement as of the 1st of July concerns APP reinvestment only and nothing else. We have forward guidance on PEP reimbursement, nothing until 24. And you will find, I think, in the annex to my statement, reference to the PEP and to the principle of flexibility, which we believe is an important key aspect of...
This is jumping up real quick, guys.
So those tools are intact. We're not planning on not reinvesting anything that comes for redemption under the PEP
Back
agreement.
to 355.
On the on TLTRO, well, TLTRO, you know, there is no surprise about TLTRO. If anything, we have managed to offer the possibility for banks to accelerate and anticipate the
I
reimbursement.
really hate all of the acronyms that the ECB uses. It's so hard to keep track of all of their different programs.
In the, you know, over $1 trillion would have become outstanding in June. Thanks to the accelerated reimbursement, we're now down to 477. I'm checking the numbers because I want to be clear on that. So it's not a surprise. It's a come due date, and reimbursements are due. And I know that banks have prepared for it, and that there is a lot of liquidity out there to continue to prepare. Having said that, you know, it wouldn't surprise me if some of the facilities that we have, that are standing facilities, liquidity windows that are available, full allotment and rates that are well known to all, would become usable. They are usable, but would be used again, because that's perfectly normal job of a central bank to actually provide liquidity. You know, we have weekly, we have the LTRO, 3 months, full allotment on all those liquidity facilities, and if anything was to happen, we have demonstrated in the past that we can be inventive. Thank you.
Thank you very much. This concludes our press conference today. So I wish you all the best. We have...
Okay, so did you just see that like as soon as he said, okay, this concludes our press conference, the E-mini sold off a little bit more? Did you see that? I am a little... I'm like trying to keep my cool. But the further along that this gets, the more crazy things seem to get, and the more upset about the situation I seem to get. Anybody else feel that way? Like this regional banking crisis, quote unquote. I'm starting to get like really mad about it. Come on. Like, here's the thing. I heard science. Yeah, I'm sure. Because they have a lot of corporate real estate loans and stuff. So like, here's the thing. Yesterday, when we were doing the Federal Reserve meeting, somebody asked, what do you think will be Jay Powell's legacy? And I was like, I don't know. But this whole thing that we had yesterday, where he's in the press conference saying the banking system is sound and resilient, and then, you know, while the thing is happening, we have a bank basically like crumbling in front of our eyes. Whether it's fair or not, I think that's going to be one of the things that people remember about Powell. That is like just an unprecedented embarrassment for the central bank to have that happen. And like the thing that just drives me nuts about all of this is that they're going to blame the Federal Reserve. And to me, like, the Federal Reserve is just a force of nature, right? If inflation is high, they're going to raise rates, and they do what they're going to do. And, if you don't want them to raise rates, then you shouldn't have done all of the things beforehand, like all of the economic stimulus that kind of forced them to have to do this, right? Meanwhile, nobody talks about all of the other players in this. Like, what about the administration, and in particular, Janet Yellen, right? Janet Yellen was the first one to come in there and kind of give people question about, like, well, the FDIC can't insure all of these deposits, or we're not going to do anything about it, right? She basically threw them to the wolves. And now, in this past week, they made it even worse by basically taking the bank, First Republic Bank, into receivership and then immediately selling off the good parts. So, like, there's no reason for any bank to come in here to these regionals and, like, give them a loan or help them out or anything, right? Every incentive now is let the regional bank go under, and then you can pick up the valuable assets afterwards, right? So when we talk about systemic risk, I do not necessarily see systemic risk in the system right now. It's not one of those things where it's like there's this one asset and they sell it and then that causes a sell and it keeps spreading and they're all subject to the same risk. Instead, what has happened is the government has come and basically undermined an entire sector. And at this point, I'm like having a hard time not seeing how this is not all intentional. You know what I mean? Yeah. Lynette Zhang thinks there is a banking consolidation going on where big banks will absorb others. That's exactly what's happening. Like, under the current dynamics, unless the policymakers wake up and change their strategy here, all of the regional banks are just going to go kaput. I don't see how, like, there's no, normally in a situation like this, when everybody's panicking and things are going down, I'm sitting here like, ooh, hey, this might be a good opportunity to like pick something up for really cheap. Because I can remember in 2008 when Google and Apple were like so ridiculously cheap, because tech was down and it was like, this is like the easiest trade of the century, right? So I'm looking for that. And the obvious one would be go long regional banks. But I can't do it. I just can't do it because even if all of this passes and like maybe some regional banks come out of this and survive and some don't, the ones that come out of this, they aren't going to be making tons of money, right? Like this whole thing is basically set up to make things harder for the regional banks overall. So how can you're like increasing the regulation, you're making it harder for them to make money, etc. So how are they going to survive? How do they get through this? Right? Everything that these guys have done has basically served to undermine the regional banking sector. That's why I say it's not the problem that we're having right now is not systemic risk. It's that the government basically, through their actions, have undermined an entire sector. Don't regional banks have some responsibility? Well, so what you're seeing happen right now is that like the most irresponsible people are the ones that get hit first, okay? But I think that there are a lot of these regional banks that are just getting absolutely destroyed right now that really didn't deserve it. And it's going to be very negative for the communities that they serve. Like one of the top ones on this list is Zion's Bank, okay? And Zion did not have these problems, like they only serve to rich people and all of these things. They weren't doing something dumb, okay? But what they were doing was they were just serving their community and providing corporate loans for this, for a service that the community needs. You need people, you need office buildings, places for people to work, and they were providing the loans for it. And then you come in and the government comes and does something that basically destroys corporate real estate. And now you're stuck with the losses. Did they really do something dumb or irresponsible? They didn't. And my community with Zion's Bank gone in Utah, that's like the main regional bank that all of the small businesses do business with. It's gonna it negatively impacts us. And then we're gonna have to go to JP Morgan or Citibank or whatever, and you're not gonna get service tailored to your region, right? the consolidation is not a good thing, right? That's what I'm saying. Like, yeah, Silicon Valley Bank did a couple of dumb things. First Republic, I think not quite as bad, but they did a couple of dumb things. Now you're starting to get into people that, you know, were just minding their own business. You know? Anyone have any idea what's going on with Xi'an? I'm not entirely sure, but I do suspect that it is flows related to regional banking. So one thing we should know is that, well, so let me kind of walk through on the chart here what I think was happening, right? So I'm not entirely sure why, but for some reason, well, I shouldn't say that. ECB came out, what ECB said, it was kind of hawkish, right? They said, like, yeah, we're going to hold interest rates here for a while, but we're not letting up on it because inflation is still a problem. So that's hawkish. They sold off. The problem with that one is that the euro did not get stronger. So I'm not 100% sure about that one. That's like a really big wrench in my theory, okay? But they moved down. Then we kind of had this period where it cooled off. So this is like post-meta order regime change, right? This taking off happened right about when they were ending the press conference. So it seemed to me that the market saw the press conference was ending and they were like, all right, let's go do our thing, buy treasuries, sell equities, right? Then you get this huge flow. Now look, the deltas on it aren't super high in the 10-year, but you continue to see the buying be, well, look at that. There's actually pretty strong buying in the 30-year too, okay? And then you come over here and you look, okay, S&P 500 down pretty good. And in the period where it's down, you're seeing a really heavy correlation with the KRE, Regional Banking ETF. So that's my best guess. And considering that has been our best guess through pretty much all of these buys that we've seen this week, I guess that's what we're left with. But I'm sure glad that I held that. I wish that I had added a contract down in here. I wanted to get one at 116 and I thought I'm going to let it go through and then see what happens. And then maybe I'll take one there. But what happened was it went through. It was only there for a brief moment and I was distracted. I wasn't paying attention to it. So I missed my opportunity to take a second contract there on this sim trade. And with all that said, they are coming back pretty hard. It kind of seems to me like the play right now is like stock the long in the event that something crazy happens again, right? It is. I'm just like, I'm reading. I really think, though, like the problems that we're having, I really think come back to the Biden administration. It seems like that Joe Biden is not really there. And so you have his team is running things and making the big decisions. And I don't have any confidence in his team. I don't think that they're the smartest people. I think that they're a bunch of radical left activists that have absolutely no clue how to run a government. Some of them were diversity hires. I mean, I'm really hesitant to say that because I can't say, just because somebody is, fulfills a diversity requirement doesn't mean that they're not qualified. But like take for instance this guy that was working in the administration that ended up being convicted for like stealing women's clothes and stuff like that. Like was that guy really qualified to be working in that position? It seems like not. Seems like you guys were not, somebody was not doing their job because he should not have been in that position. That was a bad hire. The more you brag about the diversity of the hire, probably the less qualified they probably are. Maybe. Plus, the other issue is I can't look at like every person and say like they're qualified or not qualified. I can just see like the overall thing. Like, what is the strategy? They do what the far left activists want, basically, and they're not doing sound policy. And whenever it comes down to a question of like sound policy, like nothing happens because these people are completely clueless about it. Like, what should you do when you're coming in here and there's a regional banking crisis? Because I tell you what, if I was president, I would be having a meeting with my Secretary of the Treasury and the Federal Reserve and all of my other finance people, SEC, CFTC, etc., and with Congress. And I would be saying, there's a real problem with this sector. We need to be doing something. We need to be crafting a law to fix this problem. Maybe that means that we need to change the way that the FDIC works. But the way that things are right now that Pandora's box has been opened, the regional banking sector is screwed and we need to do something about it. And the Biden administration doesn't do anything. They just, they have a press conference every once in a while that's like, well, we're monitoring it. It seems like everything's fine, etc. Right? It's because these people have no clue what's actually going on. Right? And then you have people like Yellen. Surely Yellen must know what's going on, but because she doesn't feel like she has enough power, she's not, her position in the administration is not like what Yellen says is the truth on finance and we need to go and do it. It doesn't seem like that's the relationship that they have, right? It seems like that she's been put in there more as like a yes woman, right? Because she's embarrassed herself multiple times on things that I just can't imagine, her ever saying, and just towing the line with the administration, particularly on the inflation issue. That was just straight up embarrassing, right? And it seems to me like they didn't pick Yellen up because of her policy credentials and that they want to implement her policy. They put her in there because people will listen to her and she can tell us what the administration wants to say. But she's not actually like, her influence on actual policy is minute. Yell at them. Yeah, and the issue is that this thing is kind of like a slow motion train wreck. So I'm kind of sitting here like, well, this doesn't seem right. But I can't come out here and be like, all right, guys, like now is the time to just go long treasuries. This is a disaster. Go long wherever it is. Hold it for a week. You'll probably be okay. This is where the problems, and we can get all loud about it. Like it's such a slow moving disaster that we're just kind of like stuck, frozen at every stage, too afraid to like come out and actually like make some big call about what's going on. But yesterday I think was like a big wake-up call. Yesterday to me was like, we should probably be people should probably be panicking about this, and we're not. Like the administration should be going, oh my gosh, this is really, really bad for us. We need to tackle this issue. This is going to lose us an election. This is going to do all of these bad things for us, right? The Federal Reserve should be looking at this being like, this is a really big problem. Like this completely undermines any kind of credibility that we have. But like, you get nothing. You got nothing. You think it won't lose them an election? If you lose the regional banking sector and you have a severe recession off of this, and then you have trouble pulling yourself out of the recession, because like here's the thing, is that they're saying like, okay, we'll probably have a recession. Like even the Federal Reserve is saying, probably going to have a recession the second half of the year, right? But it'll probably be a mild one. Okay, I don't know how you decide that it will be a mild or a severe recession, but whatever. I'll just go along with it. It's a mild recession. The way that I see things right now is it's not just that you're going to have a mild recession. You're going to have a very long recession. Like we've had a very slow decline. And I think when you get down in there, it's going to be very difficult to pull yourself out of the trough. They're not going to be able to just like, turn all the money printers on and then the markets just take off again like it did during COVID. You won't be able to do that because the inflationary pressures will still be there. So you're going to have a recession and you're going to stay down there. And if you stay down there up until the election, that absolutely is something that will ruin your election chances. The left seems to think that everybody is just going to vote based on abortion next. I don't think it's going to work out that way. Let it crash and then cancel Social Security. Well, I tell you what, having like a really bad market decline here would be really nasty for a time when a lot of boomers are starting to retire. Like my parents, they were really smart and they had a really good financial advisor that was really able to play the market correctly and save them a lot of money and put them in a really good position to retire. Most people aren't going to do that, and anybody that is old and still has their money, in the markets, whether it was in markets or in the stock market or treasuries, like they got screwed, right? They're going to be more reliant on Social Security, basically. Yeah, the banking sector is going to collapse. What did you hear about that random black guy that died in a random violent encounter in New York? You know what the problem is? Like the larger problem, I still think, is that the internet is like a really powerful tool, and there's a lot of great things about the internet. But we basically turned it, and I think that this was in part due to corporate and government encouragement. We turned everything into being about virality, getting a message and everybody talking about it. Whatever the news story is, like everybody's got to be talking about the news story because that's the thing that gets the most clicks, and getting everybody to talk about the same thing. That's not the positive thing for this society. What would be a much better model for internet communities would be small, very interactive communities, similar to like what we have here on YouTube, right? Only a few dozen to maybe 200 active people are regularly talking to each other every day, and that they like know each other, right? When you go on Reddit, you don't know the person that you're responding to a comment with. It's just random people, right? And then everybody gets hyper focused on the same stupid issue, usually things that aren't actually to your benefit, right? Yeah. Yeah, the rest of the world is dumping their prisons. I don't know if all of the people that are coming in here are in prisons, or should be in prisons. I think that's a little bit far, but I would say that what they're doing on the border is going to be a disaster. Like, it was really bad before, and now when Title 42 ends, it's going to really be a big disaster, yeah. The other issue with all of this and kind of tangent to this is that I think that the way that we took the internet kind of destroyed the independence of the press, right? Because the press is basically held captive to your clicks. They have no choice but to go for whatever the story is that's generating the clicks, which are very often sensationalism and not serious stories, right? Like I can't come in and have, give too much coverage to what did the change in the Federal Reserve mean, or how should we change current regulation to help address the regional banking crisis. It's just not generating enough clicks right now, right? And one of the things that these companies need to generate the clicks is the strong relationships with government. And the government decides to push certain issues, the media basically has to go along with it, or like they can't make money. So that's when you get these things where it's like, there was a guy who was a undocumented immigrant. Let's use their terminology, they say, and like he shot a family. Like he was shooting out in the yard, and the family told him to stop doing that, and so he came over and shot the family. I shouldn't have even been in the United States at all. Story gets completely ignored. Like it's like you're not allowed to talk about it. When it was Donald Trump, it's all kids in cages, etc., etc., etc. Now the problem on the border is like 100 times worse. Complete silence. You know what? I saw some stuff about this story the day that it happened on the conservative subreddits, and I haven't heard a thing about it since. Like Title 42 ending is like a big deal, and even the conservative websites aren't really saying a whole lot about it. Right. So when you have that situation in there, what ends up happening? Whoever is the administration in charge ends up having a significant amount of control over the discourse in the country. And what the Joe Biden administration is doing is objectively harmful, basically. Yeah. And, assuming we get Joe Biden out of office in 2024, can we ever recover from this situation? Can we actually, are these systems now too ingrained that it's impossible to fix the situation? Well, the kind of declines that we were seeing in the regional banking sector and the S&P 500 have normalized for now. The Treasury is kind of pulled back. I'm still really have to wonder what that huge impulse of buying towards the end of the ECB press conference actually was. But that said, I'm not actually seeing the flows reverse. So even though prices came back here and stuff, probably because it was such a strong up move, the cumulative deltas all continue to be persistently long. So I suppose that might make this an okay area for longs, but we haven't really moved too far here in micros. Now I know how an ostrich feels? What? Is this one of those Seth's being ADHD and just doesn't get people's jokes anymore sort of a thing? So these days I feel like I'm like, you guys will say funny things and I'm just like, huh? Or like I just don't even know how to respond to it, you know? My head is in the sand. I got you. So let's come in here and see what we got for some analysis on some of the numbers that we had this morning. Oops. What's this one? Russia says U.S. behind overnight drone attack on oil refinery. Okay. Okay, so I'm going to read a couple of stories here for you guys, all right? Yeah, of course, if you bring up a comment or another subject, or you go back on what we were just talking about, I'll go and address this. First Horizon Corp shares crashed in pre-market trading after Toronto Dominion Bank published a statement outlining how a deal to purchase the Memphis-based bank has been terminated. The announcement comes after multiple regional banking failures. The lenders said they both entered into a mutual agreement to terminate their originally announced merger agreement announced on February 28th. TD said it does not have a timetable for regulatory approvals to be obtained for reasons unrelated to First Horizon because there is uncertainty as to when and if these regulatory approvals can be obtained. The parties mutually agreed to terminate the merger agreement. Yeah, I don't know. I anybody that's sitting there doing that deal has to be sitting there being like, does this even make sense? Why not just let the bank go under and then I can buy the assets, the good assets, without the bad stuff, right? Me. Okay. Okay. That video was basically saying that it won't be a pause, that the Fed will have to keep raising rates. We'll see. Okay, 2 days after an unexpectedly weak JOLTS report and 1 day ahead of tomorrow's closely watched April payrolls report, when the U.S. is expected to add just 182 jobs down from 236 the month before, this morning, the BLS reported that in the last week, the number of initial jobless claims jumped from 229 to 242, rising above the median estimate of 240, and the third consecutive month of initial claims prints above 200,000. The not seasonally adjusted number rose by slightly lower 219. Meanwhile, continuing claims dropped modestly from a downward revised 1.843 million, but remain near the highest since December of 2021. The state-by-state breakdown showed that while most weekly change prints were in line, New York was once again an odd outlier with an outsized drop of 9,358 in claims. Wow. Biggest winner, by the way, Massachusetts. Meanwhile, earlier in the day, the latest Challenger's job cuts report found that in April there were 66,000 job cuts, up 176% year over year. So far this year, employers have announced plans to cut 337,000, with a 322% increase from the 79,982 cuts announced in the first 4 months. Anyway, some of these numbers, it's just like, I don't want to read all of them. You'd have to go and read them yourself, right? As shown in the chart below, the divergence between the reported initial claims and Challenger continues to be rather big. Retailers and consumer goods manufacturers are preparing for a tightening in consumer spending, particularly with the Fed's hike to interest rates in an attempt to control inflation, Andrew Challenger, firm's senior vice president, said in a statement. Retail led all industries with 14,000 cuts, up 270%. Retailers and consumer good manufacturers are preparing for a tightening in consumer spending, particularly with the Fed's hike to interest rates in an attempt to control inflation. Didn't they just say that? They posted the same quote twice in the article. That's funny. The technology sector announced the second most cuts. Finally, while job cuts fell in April from March, hiring plans have also fallen significantly from 2022. In April, companies announced plans to add 23,000 positions for a total of 93,000 so far this year. This is down 81% from the 486,000 hiring plans announced in the same period last year. It is the lowest number of announced hiring plans through April since 2016, when Challenger tracked 38,000 hiring plans in the first 4 months of the year. That was when we were having the taper tantrum, by the way. Okay, this one is from Simon White, Bloomberg macro strategist. Hold on, I'm going to try blowing my nose. By the way, I'm going to say this large meta order that we had up ended at 7:45, so that means that we could maybe start to see it in the next 15 to 30 minutes. If there's a second leg. Okay. So what's this on about? The full force of the rate hiking cycle is about to be felt across the economy as the Federal Reserve pulls back from warehousing duration risk, leaving the private non-bank sector acutely exposed to higher rates and credit spreads prone to significant widening. There's been no shortage of surprises in this cycle. For one, it is remarkable that despite the fastest series of rate hikes for decades, equities are less than 15% off their highs. The VIX is little changed from when the bear market started, and credit spreads are not wider. But like a cyclist at the front of a peloton, the Fed has been shielding the economy from the full and mounting headwind of higher rates. Now, though, the central bank is making its last hike of the cycle on Wednesday, it is pulling to the side and allowing the rest of the economy to face the impact on its own, deepening a recession that may already be underway. Wider credit spreads will be the main adjustment mechanism as non-bank private sector balance sheet come under greater stress from rising interest rate risk. The Fed's duration shedding program, QT, began last summer. As it progressed, it was anticipating that banks would shoulder much of the burden, increasing their ownership of U.S. Treasuries, mortgage-backed securities, and other debt securities. Instead, they have been shedding duration risk and at an increasing rate. The net effect is that the non-bank private sector, corporations, and households absorbing ever more duration, meaning the hitherto dampened effect from rate rises is about to intensify. Okay, so how does the bank foist duration risk onto the public? Change in holdings of debt securities. And they show that banks and other financials have shed duration risk and corporations have added it. The chart below shows the stark difference between the 2008 recession and the state of play today. Back then, both banks and non-banks owned a much larger proportion of debt securities, while the Fed's QE program was only in its embryonic stages. The recession was one of the longest and deepest seen for many years, as the brunt of higher rates transmitted through wider spreads was absorbed by the bank and non-bank sectors. By this time around, the Fed and banks are jettisoning the duration risk, while corporates and households are becoming increasingly exposed to higher rates, with this exposure accelerating in recent quarters. The vestiges of central bank protection are fading. That's not likely to change anytime soon. The Fed has given no hint it intends to curtail quantitative tightening, although the new BTFP facility can act as a standing buffer if financial stress worsens. And banks look set to keep selling their bonds. Oh, we did get a little bit of a jump there. Chart below shows that the Fed rates lead to banks lowering their exposure to debts. On top of that, the non-bank sector is facing a rapid squeeze in credit availability from banks, as this week has reminded us lenders have been at the sharp end of the Fed's rate hikes. That's especially the case with smaller banks who loaded up on safe assets to meet regulatory constraints. I think that I kind of should be doing something here, huh? Okay, there is a lot of fraught action here at 14, man. Some big icebergs, some big sweeps both directions. Pretty aggressive up movement, S&P 500 down, KRE taking a new low, not seeing anything from my news squawk. Oh, no, wait, you know what? I'm not connected to my news squawk. I should turn that back on. Wowzer. Wowzer. Whoa. Whoa, 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 whoa. That was astounding.
So wow. Becomes the latest US bank to explore a potential sale, according to FT. So we did see their stock.
Okay, the headline is Western Alliance is now seeking sale.
No official confirmation yet, but according to the FT, Western Alliance becomes the latest US bank to explore a potential sale. So we'll get
this is according to the Financial Times. Is this a stop run? I don't know, but I wish I could have gotten a better exit there on that. I don't like seeing it come back like that. Look at this. This is some pretty insane volatility. This spike was a little bit too much, and they completely got sucked back into it, right?
FT report.
Okay, so Western Bank is of course halted.
So according to Moody's Analytics, US GDP growth would be 1.61% in 2024 under the Republican debt limit plan versus 2.23% otherwise.
No one can say bonds are boring anymore.
Also adds House Republicans.
It's been a long time since I've seen a sweep like that, right? Like, I think I'd have to go back to like the Donald Trump trade war for moves like that in the treasuries. That was nuts. And I'm quite surprised that I was able to get such an easy position before it went too. But it did come back awfully quick. It was short-lived.
Moody's also adds the Republican plan would cost 790,000 jobs by the end of 2024.
I'm hearing stuff from the news squawk that Moody's released an analysis of the Republican plan to cut the debt that doesn't sound good for like jobs and so forth.
At 10:30 a.m.
House Republican debt limit plan would meaningfully increase the likelihood of recession, says Moody's. Yeah, they're probably right.
Hired advisors.
I mean, you're decreasing government spending, that's going to have a negative effect on the economy.
So according to the Financial Times, Western Alliance Bank has hired advisors to explore its options.
Explore its options. See, okay. Oh, sorry. You shouldn't be able to hear him. I'm sorry. You're not allowed to hear him. They have hired advisors to explore its quote options. Here's the problem. They don't have any options, right? Who would buy it? Who in their right mind would buy it? Just let them fail and pick up the pieces afterwards. That's the more profitable thing to do in this situation. They're going to go under. I think both of these ones are probably going to be gone. Must be fun for any of these quote advisors. Okay, Western Alliance is back up. Oh, that's wall. That's right. Yeah. Oh, geez. That's funny. So they halted it. It unhalted. It gapped down and immediately got halted again. This is nuts. Market panic as regional bank stress spreads. What a massive clusterfuck. Dude, I have not seen this in treasuries in a long time for sure. something I want to note that, we note every time that this has been happening, but again, the interest rates are reacting to this much more strongly than the equity market is. Of course, the equity market is responding to it, but the interest rates seem to be reacting first and more extremely. Jeez, look at this. Okay, I'm not seeing the reload. I would expect to see maybe some reloading in here, and I'm not necessarily getting that. So let's see here. This also isn't above the overnight levels, is it? No, it's not, because overnight we were as high as 116.25 half. Oh, look at that. That seems so far up there, but that just shows you how much we've moved this morning. That was a big move down, and now we're getting another massive move up. I wonder, last week there was quite a bit of shorts in the treasuries, and I wonder how big that short still is, and if that's, some of those guys are stopping out off of these past few days. But I'm not seeing some of the I don't know what I would call them games, you get up to the highs and then there's a big absorption on the bid and they smash it through. That didn't happen. Deutsche Bank doesn't look good either. I'm gonna bring KRE back up. Okay, so this Moody's analyst that I've been hearing on the Squawk, they're saying that the debt limit is likely to happen on June 8th. That's awfully close. That's awfully close. Okay, so we're getting another flood of volume coming in long. Now we're coming up to that first kind of big benchmark large order at 116.22 in the ZN. This is a tough call. I am seeing quite a bit of volume trading in here in this area. That's something that could potentially cause a liquidity hole. But I'm also seeing that the liquidity looks very, very light. The market makers have pulled their orders out, right? Remember earlier in the day when we had 2,000 bids down, the bids were as high as 2,000 down at the lows, right? And now they're hardly even getting 1,200 at any of these prices. So we are in a situation where the square root law doesn't apply, essentially, right? Could just keep going. The market has become unhinged. I should tweet this. I should tweet that. This is kind of exciting to me. This is kind of exciting to me because we're in a completely different kind of market situation now. Okay, we just got the oil numbers there. Okay. Jeez. They took a step up and it was like they didn't even wait. It's just like the orders are just immediately hitting into it. We've still got a ways up to go before we're above the overnight highs, but given the situation, given that the overnight highs were set by Pac West headlines and now we're getting another bank coming out, I think there's probably more than, of course, that happened during low liquidity. So, man, when you look at like the order flow that we've had since the bottom here, we are net 30,000 contracts or so. I keep seeing some icebergs on the offer, but they just bust through them. They're not getting through it for now, but it does appear to be the 5-year driving this with steepening. Steepening like this is not, you know, that's a sign that we're going right into a recession, right? When the recession hits, that's when the yield curve steepens out. Okay, so we're talking in Discord with Alligator, and we're just commenting on how there was, during the ECB press conference and everything, pretty aggressive shorting in the treasuries. And I'm kind of thinking that that's not a coincidence. That is not to say that it's like some sort of conspiracy, like somebody is throttling and pushing this market up and they're doing, actually what I think may be happening is that some of these banks that are being pressured are being forced to come out and sell to the market. Like, remember that kind of the thing that precipitated the collapse of Silicon Valley was that they took losses on their treasury holdings. So I'm wondering if, you got these banks, they're coming out, they say, okay, like, it's over for us. We got to do what we can. We're going to sell all of our treasuries, and then we're going to take the bad assets off, and then we're going to see about somebody buying us or something like that. And so it's like they go out, they sell all of the stuff. Maybe some of the other banks know, and then the headlines start to hit. Oh, okay, yeah, they're looking. Because it seems like it plays out that way every time, is that there's like people are being squeezed, longs are getting squeezed, and then all of a sudden the bid comes out of nowhere. Okay. Well, we stopped just short of the overnight highs, and we're pulling back pretty decently here. Man, that sure, I was thinking, I could maybe get out at 30, maybe $25. Now I'm looking at like 16. Tough call from here, because we've kind of seen this a little bit before, where like it comes up and then it bounces up there a few times before going badoosh. So you really think that it's done, and then like another shoe drops. That's what happened yesterday, right? Really looked like they were coming back, and then it just shot right back up there almost immediately. And there was like a headline came out at the same time, I think. Forex Live tweets, the banking system is sound, the sound of glass breaking. What's this? News Squawk, imagine if every Greg's was a bank. That's what Americans are dealing with right now. What is Greg's? Is that some grocery chain out east that I am not familiar with? Strong pullback, strong push back to highs. Deltas relatively mild, so again the liquidity has like evaporated. What's this? Oklahoma is taking action to ban 13 major financial institutions that are pursuing ESG initiatives from doing business in the state. The energy sector is crucial to Oklahoma's economy. It is essential for us to work with financial institutions that are focused on free market, etc., etc. That's kind of weird. I wouldn't be going as far as to like ban certain institutions, but whatever. Oh wait, what happened there? That did not go the way I planned. Okay, I got 28 out of it. It's fine. Fine. I actually maybe want to be back in it though now that happened. I didn't like the way that it was moving. I think I just got scared out of it. Oh, Seth, what are you doing? No, it's doing this. I think that what I'm starting to see is it is starting to establish a range. So I think there's a very high probability that we do push higher at some point. It might be some time. And I've got 20 minutes left. That's a good win for today, though. Good win. I love the smell of napalm in the morning. It's the beer. I should really lean into it more, man. The time when you can make the most from treasuries is when everybody else is freaking out, right? And you mean like, yep, I told you so, and you can be long and everybody's buying it from you. Yep. Yep. Ooh, that is a good. I totally forgot about that, Octavius. It does sure seem like they're destined for 4,000 over there, doesn't it? Okay, we're coming back down a little bit. I think I can relax. I think I did the right thing. So when we look at ES, oh yeah, they are pushing new lows. So we're coming back into March numbers now. Oh man, oh, this is interesting. So I think it'll be easier to show this to you on a daily ES chart. Okay. There is this kind of like single Brent area right here where there was like they topped off, they came back, and then they shoved through it really, really quickly. So we're in a support area of sorts in the ES. And it does look like maybe there is some support here. But if that support fails, which is more likely in this situation because there's like real news moving it, right? You could fall down through this. You could see 4,000 very, very quickly. And I don't think that it would be too difficult for them to, you know, do 100 points in a day in this kind of situation, right? Now, another thing, I can clear that. Look at oil is just getting savaged again. We'll come over here and look at oil. Okay, so there was some lows from yesterday. There was lows 64 at one point, but like, look, we started the day at 69. We're already down $1.25. That doesn't look good for oil. Silver, biggest winner today. Silver's looking good. Oh, let's come back and look at silver on this chart. Oh yeah, look at that. Silver is right on the precipice of a nice looking breakout, maybe. No, it doesn't tell us if it's going to break out or not, but I think it could be awfully nice if they do it. Yeah, so I'm definitely seeing it. I think that I could possibly get back in here at like 331 or something, maybe. No? Gotta come back over here. I'm just kind of wondering, like, I kind of played it safe there a little bit. This would be a situation to push it. I guess actually if I wanted to push it, I should have done it earlier. When we were seeing that jump up and everything, I should have pushed it. And then when it pulled back on me, I should have doubled down. But I think that I got the easy profit. Is the profit that you get through holding through all of the mess now come through? We'll see. Okay, let's just read Zero Hedge's synopsis of what we're seeing. Make sure if there was any headlines we missed. PacWest shares halted after extending route to 52%. KBW Bank Index down as much as 5.5% to lowest since September of 2020. S&P 500 falls 1% to lowest intraday since March of 30th. And now Western Alliance has joined the collapse. Western Alliance resumes, extends slump to 45%, halted again. After Financial Times said that it too, like PacWest, is exploring strategic options, which is basically code word for we're totally fucked. Please, somebody save us. Oh. Whoa. Western Alliance still talks as false. The headline I'm hearing is that the Western Alliance still talks as false. That's too late. Man. Okay, wait. So on this one right here, we're gonna close that. Holy crap, guys! This is some of the crazy stuff. I don't think I have ever gotten more lucky on a set of trades than this week, man. That was so crazy. That you know, I just didn't quite like the way it was behaving. Like, you know, I think that was really. I really think I got out of that trade for the wrong reasons, right? There was probably some really good reasons to try and hold that through. And, but I just happened to get out of it, and that was a really good idea. I could maybe try taking it like around 320 or something like that. Oh, finally, I was able to get that big wad of snot that's been in the back of my nose all morning. That just made the book shit its pants. Yeah, like you thought the liquidity was bad before. this is what I think we need to come up with a new name for this. Because I wouldn't call it a flash crash per se, because it's not like it's crashing and it just, but like the liquidity is gone. The liquidity is just completely gone. We should call it a shitfest ravioli. Okay, that's what we're calling it. I would think that we could maybe put in something about liquidity in it. It's like the market makers shit their pants. Like, oh yeah, absolutely, I think. So just to review what I did, I was kind of starting to detect some hints of like really excessive longs coming in. I suspected that it might be a banking headline, so I went short interest rates over here. I was able to pull, I think it was $28 out of it. Yep, I was able to pull $28 out of it. And then it started to get a little bit, it started to establish a bit of a range and get a little too volatile for me up at the top, so I took some profits. Meanwhile, I had this long from after the Federal Reserve meeting that wiped out the loss that I had during the Federal Reserve meeting, and it was a sim. And on that one, when it came down in here, of course, I could have held on and let it come back up, but I just decided to puke it back at 116.16. Now, the price is flipping back up here. I would be very careful about reading too much into any of these moves now because the liquidity is so low. This is just going to move all over the place. And the other issue is like, you're getting like a conflicting headline sort of a thing. So something that I've found has happened before when you get something like this, it's like a headline comes out and then they say, oh, that headline is wrong. You would think, oh, okay, so like all of the movement that happened off of that headline should like retrace itself, right? But that's not what actually ends up happening. So we may stay a little bit higher here than it seems like. A Western Alliance halted news pending. Western Alliance halted news pending. Well, let's see here. I'm gonna stick around until we find out what's going on with that. I may just, I'm gonna have to do my morning stand-up meeting. I will just like mute myself while I'm doing that. It's a good trade. I'm really happy with this week. They come back. The first. Oh, that's actually really interesting. I only took 4 trades this week. I thought I did more than that. I think if I go back even further than that. So if I go to like April 24th. Yeah, there's that $41 one. Wow. I made a net $94 in the past 2 weeks. That's better than I realized. Well, now I better start being careful. I give it all back. Maybe I could just call it a liquidity collapse. That sounds dramatic enough. I should be taking a look at VIX. I'm wondering, you know, because one of the things that we've had during all of this is that like VIX not move as much as it should, but I bet that one probably made the move, huh? Well, it's jumping back up there again. And put 2 headphones on here. So we're back up here to the highs. It kind of seems to me like the shorts are still kind of trying to push these banks, but I'm just gonna sit here and wait until Western Alliance is unhalted, okay? Okay, so I'm back. I don't know, like for the Financial Times to put a story out and it get denied by the company is incredibly unusual, I would say. It is absolutely true that people will plant false news stories out there to try and move the markets for sure. But you know, another thing that happens, and certainly is happening right now, is that not everybody in the market gets the news at the same time, right? Because there was some very aggressive buying before the ECB press conference ended, and then definitely started out after that happened, you know, and then it kind of like sat for a while, and then the actual news hit. And we had another huge move after the actual news hit. So it's just kind of a mess all around, right? But the thing that we just have to remember is that we've had a liquidity nuke. They can't even put 1,000 contracts up on the DOM. That completely changes the behavior of our market. And, you know, especially for market making methods, that it can make those trades very, very risky, right? So, like on this one, we didn't really get the square root law. I think that what happened was they just ran out of orders for anything to happen, you know? And then because of that, this range that we've had is really wide, really wide. So I do see, let's see here. So I'm going to read their statement. The holding company for Western Alliance Bank today issued the following statement in response to an article published by the Financial Times. The Financial Times report today that Western Alliance is considering a potential sale of all or part of its business is categorically false in all aspects. There's not a single element of the article that is true. Western Alliance is not exploring a sale, nor has it hired an advisor to explore strategic options. It is shameful and irresponsible that the Financial Times has allowed itself to be used as an instrument of short sellers and as a conduit for spreading false narratives about a financially sound and profitable bank. We are considering all our legal options in response to today's article. So now I'm hearing that UBS is considering options for the Swiss bank Credit Suisse that it acquired, including even IPOing it, which is kind of funny. They're going to take it and then respin it back off. Okay. That's kind of a weird headline. Okay, well, it's been about 30 minutes. The KRE has definitely recovered. It still looks like the spot that I got out at was pretty darned good. I probably could have made $10 taking it the other way, but that would have been a really stressful trade. I'm glad I didn't do that. I'm just checking Twitter here to see if there's anything more. Wow. There's a person that they were short and they were able to get out just before it halted. That's hilarious. Okay, so I'm for some reason I'm not seeing the stock unhalted, but I would say that now that we have an official press release, that's enough for me to say that it's definitely false. I should keep an eye out for other potential shoes to drop, but now is probably not the best time to be taking gambles on that. So I think I can be happy with what I've done so far this week, and just kind of, yeah, I think I can go to work. So thank you for those few of you that stuck around that long. I was hoping for some like more crazy action. That's why I kind of left it going, but it doesn't look like it actually ended up being that. So might as well shut the stream down. I will still be in Discord. So we should try and get Discord going a little bit further better, but I'm gonna try a couple of things. I gotta there's some real work to do first, but I gotta check out a couple of things on Discord. Okay guys, I will catch you tomorrow, Friday, non-farms. Ooh, it's gonna be huge. Okay, in the meantime, stay excellent, team.